Welcome to our channel, where we talk the federal rate decision. The Federal Reserve's decision to keep its key interest rate steady at about 5% marks a significant development after a year of consecutive rate hikes. Let's dive into the factors behind this decision and its potential implications. The Federal Reserve's primary reason for maintaining the current interest rate is the easing of inflation. The central bank wants to assess whether the previous rate hikes have been sufficient to control rising prices. Inflation remains a concern, as the Fed acknowledges that it is still elevated. The Fed's Open Market Committee stated its readiness to adjust rates if risks arise that could hinder the goal of achieving a 2% inflation rate. In a surprising move, the Fed lowered its unemployment projections from 4.5% to 4.1%. This indicates the central bank's belief that it can continue raising rates without causing significant job losses. The impact of higher interest rates has been substantial. Lending rates throughout the economy, including credit cards and corporate lending, have reached their highest levels in decades. These measures aim to curb overall demand in the economy and alleviate upward price pressure. While inflation has decreased from its peak of over 9% last year to 4% in May, it still exceeds the Federal Reserve's target of 2%. Some economists argue that the case for further rate hikes remains strong. Factors such as lower than anticipated unemployment, increased economic growth, and positive trends in bank lending, home prices, and stock prices support this perspective. Loretta Mester, a Federal Reserve official, shares the view that there is no need to pause the interest rate hikes, suggesting a compelling case for raising rates. However, others believe that the current pace of rate hikes may not be necessary. They argue that it takes time for tighter monetary policy to have a full effect on the economy. They also point to signs of weakness in the labor market, such as higher jobless claims and reduced hours worked. Austin Goolsbee, another Federal Reserve official, suggests that the tightening impact of previous rate hikes may still be forthcoming, and that factors like bank stress should be taken into account. Korkafas highlights that while the Fed can tighten monetary policy later, there may be a cost to tightening, leading to slower growth down the road. As the effects of the pandemic fade and pent-up demand subsides, it could result in lower consumer spending and slower economic growth. As the Federal Reserve takes a break from raising interest rates, it aims to communicate to businesses and consumers that there are more rate increases on the horizon. The future course of monetary policy will depend on evolving economic conditions and the Fed's ongoing assessment of inflation and employment. This ends our discussion of the previous federal decision-making. If you like it, consider subscribing to our YouTube channel to stay up to speed on market news.